All right, let's dive into one of the biggest corporate stories happening right now, the massive Vedanta demerger. We're talking about a natural resources giant that's literally splitting itself into 5 separate companies. So today, we're going to unpack exactly what that means for everyone involved.
So the first thing you're probably asking is, how on earth does one massive company just become 5? It sounds incredibly complex, right? And, for investors, the even bigger question is, what does this whole thing actually mean for your money, for your portfolio? Let's get right into it.
When you really boil it down, this whole demerger is a classic story. It's a problem and a solution. On one side, you've got this big, complicated issue that was really holding the company's value back. And on the other, you have this incredibly ambitious plan designed to fix it and unlock all that hidden value. So let's start with the problem. Why did they even need to do this?
Okay, so the main reason change was needed comes down to this one big issue, what's known as the conglomerate problem. Basically, the fundamental issue for Vedanta was something called the conglomerate discount, and it's a real headache for these huge, sprawling companies. For Vedanta, it just meant that the market was looking at the whole company and saying, yeah, it's worth less than if we added up all its individual parts separately. It just wasn't getting the credit it deserved. And this really breaks down why that discount was happening. Think about it. You had all these different businesses, aluminum, oil, steel, you name it, all crammed under one roof. So the market just kind of slapped a discount on the whole thing. Why? Well, for one, capital was being spread thin across all these different divisions. And if you were an investor who just wanted to bet on, say, aluminum, you couldn't. You had to buy the whole package. Plus, with everything so centralized, making decisions was just slow. It was just a messy structure that made it really tough to see where the actual value is hiding.
So, facing that problem, what's the solution? Well, it's a pretty radical one, actually. Demerge. Just break the whole thing apart. The plan is to create 5 separate pure-play companies. The thinking here is simple. Let each business stand on its own 2 feet. Let it be judged on its own performance, and, crucially, let it attract investors who are actually interested in that specific industry.
Okay, this is the part every shareholder wants to know. How does this actually work for me? And you know what? It's actually pretty simple. For every single share of Vedanta you own on the record date, here's what happens. First, you keep that one original share. And on top of that, you get 1 new share in each of the 4 new companies. So yeah, your 1 share effectively turns into 5. Pretty cool, right?
All right, timing is absolutely critical here, so let's walk through the key dates. The board approved this way back in September 2023. The next big step is getting the final green light from the National Company Law Tribunal, the NCLT, which is expected in late 2025. Now, for investors, here are the dates to circle on your calendar. April 29, 2026, that's your last day to buy shares if you want to be eligible for the demerger. Then, May 1st is the official record date, and by June or July of 2026, we should see all these new companies trading on the stock exchanges.
Okay, so now that we know the why and the how, let's meet the new family. We're going from one giant Vedanta to 5 totally separate businesses, and each one has its own unique focus, its own strategy, and its own appeal for investors.
First up, we have Vedanta Aluminum, or VAML. And let me tell you, this is the star player, the powerhouse of the group. It's the biggest contributor to earnings, and it's a top pick for a lot of analysts. I mean, we're talking about India's #1 aluminum producer, holding a whopping 46% of the domestic market. Make no mistake, this is expected to be the crown jewel of the entire demerger.
Next, we have Vedanta Power. Now, this company is essentially a big 1,980 megawatt merchant power plant. And what analysts are really excited about here is the growth potential. With the entire Indian power sector really heating up, this one is being seen as a huge opportunity. It's definitely the one to watch if you're looking for potential growth.
Then there's Vedanta Oil and Gas. Now, this one's a bit smaller than the others, but it's really interesting. It offers what we call a pure play investment in exploration and production, or E&P. So if you're an investor who specifically wants to get into the upstream oil and gas game, without all the other stuff, this is your targeted niche ticket.
Our 4th new company is Vedanta Iron and Steel. So what they've done here is bundle together all their steel and iron ore assets to create a brand new, standalone competitor. And it's jumping right into the big leagues, ready to go head-to-head with giants like JSW and Tata Steel. It's going to be fascinating to see how it fares in such a tough, competitive market.
And finally, what's left of the original company? Well, this is what they're calling the Residual Vedanta Limited. And don't let the name fool you. It's still a massive player. And here's why. It gets to keep the incredibly valuable 63.4% stake in Hindustan Zinc. That is a huge asset. Plus, it holds the copper and nickel businesses.
Early estimates suggest its price, after the split, will probably land somewhere in that 300 to 325 rupee range.
All right, now for the part everyone's been waiting for. The big question. What are all these new parts actually worth when you add them all up? This is where we get into the valuation and the numbers.
Well, here's a key number to keep in mind. 820 rupees. According to the analysts over at ICICI Direct, that is their sum of the parts, or SOTP, target price. Basically, that's what they think all 5 of these companies will be worth combined after the demerger. And when you compare that to where the stock is trading now, well, it suggests there could be some serious potential upside.
But of course, it's never that simple, is it? You have to look at both sides. The bull case, the optimistic view, is pretty strong. You're unlocking value, aluminum prices are rising, which helps the star player, and some brokers like Kotak are even more bullish with a target of 915 rupees. But on the other hand, you've got the bear case, and there are some real risks to consider. The stock has already shot up 75% this year, so is the good news already priced in? There's still a heavy debt load. And let's be honest, commodity prices can be incredibly volatile. Plus, there's a real chance that once these companies list, investors might just dump the weaker ones, causing their prices to fall.
So, with all that information, what should you do? Let's try to put this all together into a simple investor playbook with a few different strategies depending on who you are and what you're looking to do.
Okay, this table breaks it down nicely. Let's say you're an existing shareholder. The general thinking is to just hold on, make sure your shares are in your DMAT account by April 29th, and don't panic when the price adjusts after the split. That's totally normal. Now, what if you're looking to buy? Well, you've got to do it by April 29th to get in on the action. There's potential upside, but just remember, the stock has already had a massive run. What about after the listing? A popular strategy might be to be selective. Maybe keep the strong ones like aluminum and the residual Vedanta, and think about what to do with the others. And finally, if you're a more conservative investor, it might be smarter to just wait. Let the volatility pass, see where the prices for all 5 companies settle, and then decide if you want to jump in.
And before we wrap up, just a quick and very important disclaimer. I am not a SEBI-registered research analyst. I am, however, a professionally qualified chartered accountant who has a deep interest in the stock market. So please remember, all the information we've discussed today is purely for educational and informational purposes. It should not be taken as investment advice. It's really important that you consult a qualified financial advisor before you make any investment decisions.